What's going on, traders? Welcome to the market primer for, it's not September anymore, it's October 2nd, 2022. The markets are at a, let's just call it a precarious level. And I think that the base case here is not that we will see a range. Either we see a reversal back above those lows and then a retest, then we roll, or we go and grab some very key levels below. And we've been talking about this for a while that, especially for the S&P, let's do this. There's not a lot of liquidity here for us to work with relative to what we've seen. So prior market participants aren't going to be there to enact any kind of demand levels. There's potentially a level right around 353 and, let's just say right around 348. But the big level is all the way down here. Okay, this is the big volume shelf. That's a high volume node. That's where it tends to act as magnets. So if we were to see a good sized sell-off and a proper breakdown from these levels, then that would be the first level. And then the second level would be right around about 321. So those are kind of big macro levels. It's not a guarantee that we hit those levels. There's a lot of news flow going on right now. There's a lot of price action going on, but underneath the surface, there's a lot of things that are getting loose besides stocks. Let me just give you some quick examples. I don't want to talk about macro too much, but as an example, the gilts, which are, they're basically treasuries, but for the UK. And I'm not a gilt trader. I'm just a macro tourist here, but it crashed. And if we look at the pound relative to the dollar, it also crashed on Sunday last week. We're seeing price movements in a lot of different asset classes that show us it's just really sketchy out there. And that kind of action doesn't happen very often. And so when we see the gilt market crash, or when we see major currencies have multiple standard deviation moves, that's just a concern that we have to work with, and we have to expand our possibilities of that volatility spilling over into stocks. If we take a look let's just look at the 2-year note. Okay, so it's been a really ugly few weeks for treasuries, right? We saw a breakdown under here, just continued to accelerate. Just this move right here off this high to low, that's 3%. That's a lot for the treasury market. We don't see that very often. And given the fact that, we were all the way up here and the kind of move we've had, the bond market is currently in the driver's seat, right? It's not about stocks. It's about rates and all that sketchy stuff that's going on underneath the surface. So in my opinion, in order for equities to find some kind of a bottom, and it's possible we could see, this could be a double bottom with a new marginal low. We've seen that before. 2011 is a really good example of that. But we need to see the bond market and the commensurate macro train wreck that's going on. We need to see some repair from that. Otherwise, that will eventually bleed over into stocks. So let's go back to the spiders, and we've got our drawings on. These levels that I put on here on Sunday of last week, they're still valid, and they actually worked pretty well. This high right here, this is not something that I drew after the fact. That's just where the level is. And if you zoom in, because, we saw big crossovers from this level right here, but I'm pretty sure intraday, it was a good pit stop to work from. All right. You saw resistance here and here, you saw it here, and it just acted very nicely. These pivot levels worked very nicely for some intraday trading. Okay. So while we did see a pretty wide range, and we did see deterioration into the close. It was end of quarter, end of month. It was a very structurally normal market for stocks. So let's just back out to a daily chart. And the big level that I have on right now is going to be right at 353.07. I know that is a wide ways away from where the underlying market is trading. right? There's probably going to be maybe halfway between these two. There's going to be some pivot levels that you can work with. These three ranges right here are very wide. And so there's probably going to be something in between each where you can say, all right, that's probably going to be a place where we should expect at least some slowdown, some introductions of liquidity, right? So, there's probably a pit stop right here. There's probably a pit stop, and we did see this right here, but they're not super quality for me, at least on a swing basis. I want to see those extreme levels. On top of that, and this is going to apply both for the NASDAQ and the Russell, if we look at the average true range, where's it? There it is. All right, we're sitting at about 8 points right now. Okay, we're moving at a clip of about 8 points a day for the spiders. That's about 80 points on the S&P and the ES futures. So where does that put us? If we were to have a 1 ATR move, where's that 8 points away from here? It's going to be right there. Okay, so an 8 point, a 1 ATR move would get us down to that next level down at 348. Okay, now coincidentally, if we look at it 8 points to the upside, just from those lows, it would be basically the Friday's high and that pit stop area that we just talked about. Okay, so that is kind of a reasonable expectation for what we should expect. Maybe not in a single day. If things really get loose, that can obviously happen in a single day. But, we could have an instance where, let's just say we push to, and I just want to give you, this is path dependency. I know I'm kind of deviating here, but let's just say we see about a 4 point move to that first level, and then we see a bounce of a 4 point move to that pit stop level right here. Okay, so we could see something, and it may not happen on Monday. It could happen on Tuesday, where if we hit that level and we have enough energy generated, maybe based off of a headline because of the emergency Fed meeting that nobody's talking about yet. Maybe you should look that up, guys. That's very possible, okay? So our levels. We've got this level that's currently where the market traded into the close on Friday, right around 356, 358. That's still a valid level. So if we were to somehow see a gap up and then a push into that, that's still a decent long opportunity on an intraday basis. To the downside from here, we've got 353, and then we've got about 347, 348. And then the big level is about one more ATR to the downside, which is going to be 339, 340. I know that these are very wide, right? And I know that from here to this red line that I've been watching for a while is another 5% to the downside, right? Very possible in a very illiquid, high volatility market. So you can't rule that out, right? If we get loose here, the odds of getting looser continue to accelerate. Okay, so you just got to keep that in mind. But if we were to get that, we've got massive liquidity into that, and I think that would be a great knife catching level. To the upside, we've got 363 to 364 off of this level. We've got 367, 368, and then just above that, 373, 74. So this kind of triplet level right here, don't expect one of them to be the exact top for the week. If you look at how the market traded into these levels, we would see resistance hit, and then we would get one good stop run into that next level. All right, so if we were to see upside, let's just say we hold this, and then maybe we start to collect this level. Don't think that the first touch is going to be an obvious short. Everyone and their mother is going to be looking to short against about that 370 level if we were to get there very quickly. It's just a tougher trade to take. That's all I'm saying. So I'm not necessarily bullish or bearish going into this week. I think it's a here or there kind of idea where either these levels really start to hold or things get really weird. So we can take a look, just because I want to talk about this and I have a captive audience. Take a look at how the market traded in 20. We could look at 2016 as well, but 2011. 2011, we had this fiscal cliff thing, and this was a really nasty crash. And you have to remember, everyone, I'll tell you what, I got long here into this hammer candlestick because it's like, oh, it's such an obvious failed breakdown, and then we just gap down and we get absolutely crushed to the downside. Trade in a really nasty range for months, and then what happens? I even think is this on a weekend? For Sunday? Hold on a second. Let me zoom in. we had this breakdown that happened. I don't know why it's showing Sunday right here, but almost to the same day. This is the beginning of October. Everyone's scared of October because October 2008 was really nasty. You got to remember back in 2011, 2008, 2009 was still a very recent memory. We had a lot of disaster imprinting. We break underneath this level. It's a very clear breakdown. We gap down the next day, and then that was it. All right, it was a one-day breakdown. That is a possibility you have to consider in this market. It's not a guarantee, but we have seen precedents like that in the past. Another good example would be the 2015 trading range. All right, this August move to the downside right here. This was off of a Chinese currency adjustment. Then we traded in a very volatile range. Then we go back up, collect some big levels, and then we put in this monster double bottom at the beginning of 2016. Okay, and then we've got obviously 2018 where here's a big breakdown, multiple month range. We break down, and then it gets completely loose until the Fed blinks. All right. Again, we don't know. We do not have a good feel on that outcome. But the question you need to ask yourself in a lot of these trading scenarios is, are we seeing failed follow-throughs? Are we seeing failed auctions? Or are prices currently being accepted? Right? Okay. I'll get off my soapbox there. Let's take a look at the NASDAQ. The NASDAQ, same kind of idea. It came right into a big level on Friday. That could still be a very valid level, both to the short and long side. You know, if we gap down and then we run back into that level, fill the gap, it's a huge level. So let's zoom in here. We've got big level at 261, 262, and then 256, which is a big, big level for me. And I have that highlighted in red because there is a... it is a volume shelf where once we get to that level, there's not much until about 245, 248. So that would be a huge bounce level. That would be, I mean, if we got that quickly, especially if the S&P collected the big red line that I just talked about, I think that's a pretty good place to work from. Okay. To the upside, you know, depending on where we gap on Monday, 265, 266 is still a good level. Then we've got the prior support, potential resistance. That's coming up at about 271, 273. And then the next level to the upside is going to be 279 or so. And that's where the failed auction happened back on Wednesday. Again, very wide levels, but you have to treat this market with a lot of respect with these wide levels. You can't just throw a bunch of lines on and hope for the best right now. Next up, IWM, the Russell 2000. Again, the zones that we've been talking about based off of our trading roadmap have been working exceptionally well. I'm just going to slap on one more line right here based off of this LVN that's coming into play. And it appears as though it interacted with it on Wednesday. So I'm just going to mark it really quick. To the downside, the Russell is trading with a slight divergence right here. I do think that large cap tech is kind of where the last hideout is, and if they're going to shoot the generals, they're going to take them out. So we've got 163 to 164, and then we've got two levels, and these should not be that far away from each other, but they are. So 159 to 161, and I really don't have a whole lot on this chart. So let me just double check that I'm not missing something. We've got this weird gap fill thing that's happening right around here at 157.5. But if you look at the roadmap right here, there's not a whole lot of peaks and valleys that really stick out into that. Maybe if I zoom out a little bit more, we'll capture some more of this data. Okay, so we've got a key LVN right here. We've got an HVN that I'm just going to mark at about 157.25, and then the big level coming into play is about 154. The average true range, again, is about 450. Okay, $4.50 for the Russell right now. That's just a normal daily movement. So just think about this. If we were to see, let's just say a 2 ATR move, that's 9 points, right? Where does that put us? About 156. So that would be back down here. That's a 2 ATR move. That's very possible given the kind of volatility we've been seeing. Right? We were in a range, but it was a very volatile, choppy range. Okay, so that's just my feel right now. We could see again, we could see an instance where we sell off, we grab some levels, and then we see a hard reversal. If that happens, especially quickly, that is a very bullish, in my opinion, a very, very bullish indicator, especially if it happens in a very swift amount of time. But we'll see. We have to wait for that data for it to come in. Let's talk about the vol markets really quick. If we look at the VIX is back at, it's back in the 30s. And I thought, with the drift that we saw going into August, that we would start to establish some kind of a lower trading range, and that's just not in the cards right now. There's just a very large perception of risk. A lot of it's justified right now because things are going limit down and limit up in the currency markets, and the bond markets are still looking kind of weird. One interesting spot, the VIX, which had stayed very subdued for a while, finally saw a bid. So over the last, let's just say, week, we saw folks that were like, oh, crap, I got to go buy some VIX options. And we finally started to see that come into play. We're not at huge levels with the VIX, but it's also probably because the VIX is trading at 32, and you're probably not going to have a lot of people buying a bunch of VIX 40 calls. And if you're deleveraged, you don't have a reason to be deleveraged, or you don't have a reason to pick up protection. One thing that you have to watch also is the MOVE index, and this is like the VIX for bonds. And it has not given back any of its levels. There is still a persistent, very scary bid in protection for the bond market. If this sucker really rolls over, you're going to see a fuse lit in stocks. And that's just my hot take right now, that if bonds and bond vol start to normalize, it's going to be a lot easier to trade stocks to the long side. That's my bet. Okay. I think we've talked enough for this week. Thank you all so much for watching. If you got any questions, feel free to reach out. And we'll see you guys next week. Take care.